Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Tony Morris, Global Head of Quantitative Strategies at Nomura International, has spent 25 years studying complex market relationships across asset classes with a focus on derivatives. Our conversation explores some of the factors that drive asset price outcomes, first considering the vol risk premium. Observing the consistent shortfall of realized versus implied vol in the equity market, Tony details a similar circumstance in credit where realized defaults are lower than implied by spreads. He suggests that the existence of both the equity VRP and the credit risk premium are tied to the fact that each has a beta to the S&P, which in turn enjoys its own risk premium. Our conversation shifts to the work that Tony and his team are doing within the larger Quantitative Investment Strategies, or QIS, business at Nomura. We touch briefly on the history of QIS, a business motivated by end-user interest in systematic strategies that require substantial market access, modeling, and operational infrastructure. At its core, QIS enables the outsourcing of these critical components to a dealer who can package complex exposures into a neatly delivered contract. We talk briefly about the set of products that comprise the taxonomy of QIS. Here, Tony cautions that in constructing a portfolio, it's important to carefully consider the way in which strategies interact with attention to hidden co-movement. We spend the last part of our discussion on long-dated swaption straddles on long-dated U.S. rates, a topic Tony and team have done a deep dive on. Their work suggests that an overlay of 20-year, that is, 20-year swaptions on 20-year swaps, has favorable correlation, carry, and convexity characteristics. Along the way in sharing the results, Tony debunks a few commonly held assertions around the factors driving the returns. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Tony Morris. My guest today on the Alpha Exchange is Tony Morris. He is the Global Head of Quantitative Strategies at Nomura International. Tony, it's great to reconnect, and it's great to have you as a guest on the podcast today.
Thank you for having me, Dean.
Yeah, looking forward to this conversation. We'll get into the weeds on some of the really interesting developments in the QIS business, the Quantitative Investment Strategies business. That's definitely been a growth area on Wall Street, and I know one certainly at Nomura as well. I'm going back to our first meeting time, which I want to say is around 2016, and I was in your office in New York, and certainly really impressed with the thoughtfulness of the deck and just the way in which you and your team laid out, I guess I would call the taxonomy of exposures that can be created within this universe. And of course, that's 7 years ago. So a lot's happened, and I'm sure there's been a lot of development, both on the investment side, on the technology side, the data collection side. It's going to be a really, really interesting conversation. I'd love to get it started just by giving our guests an opportunity to learn a little bit more about you and your background. So maybe just give us an overview. Take us back to the early part of your career and just how you got to this leadership role at Nomura.
Wow, that's a long and winding road if there ever was one. Let me see if I can get started somewhere. I spent my 20s in New York City, and I was a doctoral student at New York University. And if I go way back before that, as a freshly minted college graduate, I graduated around 1990. The Gulf War was going on, the first Gulf War, that is. And I remember driving around New York City. I had a lot of time in the car in those days, listening to the radio and hearing all these reports about the oil price did this in response to Secretary of State Jim Baker having a bad negotiation with the Iraqi foreign minister. And I guess I got hooked by the impact of news on markets, how oil prices or exchange rates or equity markets moved in response to information and how different people had different views on those things. And it got me interested in finance. It got me interested in markets. I applied to the doctoral program at NYU, mainly because I learned it was free and they would pay you to go as long as you did some research for professors along the way. So I did that. And while I was there, I met a lot of people from the industry, because when you're in Greenwich Village, you get a lot of people coming up from the street for various seminars and whatever. At one of these events, I met this guy from Swiss Bank Corporation who had an issue to solve about the pricing of sovereign credit risk. And it's hard to imagine this, I suppose, but even Swiss banks have their crisis sometimes. And in the mid 90s, many of the Swiss banks got into a lot of trouble with bad real estate loans. So the regulators came down hard on them and said, you need a more robust credit provisioning framework. And they had managed to find a way to do that for corporate risk using things like the KMV model, which must be right up your street, Dean, since it's based on classical equity pricing models, Black-Scholes, Merton, that sort of thing. But they hadn't found a way to do sovereign risk. And there wasn't enough data, unlike corporate defaults, where you have thousands of defaults across history. So they needed a way to solve the sovereign risk problem. And since the KMV model was quite fashionable in those days and the regulators seemed to accept the premise, I suggested to these guys that they adapt a Black-Scholes framework to credit. And at that time, it was a bit hard to do that because there wasn't really a CDS market. There were sovereign bonds out there. This was the era of the Brady bonds, where there were a lot of credit optionality and various levels of collateralization that made them difficult to break down the pure spread. But one way or another, we got it done and they got their model. And that's what led me to what at the time was known as Swiss Bank Corporation. This was before it had merged with UBS. And so I was working in Basel, Switzerland on that. And along the way, I met basically an interest rate exotics desk in London, it's SBC, and they were in the process of setting up a credit derivatives business. This was even before the ISDA documentation had been developed. That's how old I am. Anyway, I started working for them in London after finishing my time in Switzerland. And this was right during the merger with UBS. And it was also at the same time that long-term capital was blowing up. And so basically, I got thrown in the deep end and I was part of a team that had to book a lot of the trades that the old UBS bank had on with long-term capital that had to be rebooked in what were the new bank's systems, which were essentially the old Swiss Bank Corporation system. And boy, did I learn a lot about the kind of stuff those guys were doing by having to rebook all their trades. So that's how I got into that space. And from there, one thing led to another. I started working on the pricing of credit counterparty risk for interest rate derivatives. 1997 was interesting because that was the first time during the Russia default crisis that a lot of people lost money in over-the-counter derivatives, much more so than they lost in standard credit exposure. For instance, if they did an FX forward with a Russian bank and the Russian bank went away, they were left hanging. That was a counterparty credit event. And then from there, I worked on credit models. How do you model the term structure of credit spreads instead of just using credit ratings? And from there, I went on to synthetic CDOs. And then getting back sort of towards our beginning of our story, and let's say the early 2000s, people started asking me, what can you come up with in terms of an investment strategy that is systematic in nature that we can apply to credit derivatives? And in this case, the mainstream indices. We didn't have iTraxx and CDX at that time, but it was more or less the predecessors of those indices. So I started looking at strategies in credit, and we did a few of those. And then people asked me to look at interest rates, and we did a few of those, and then currencies, and then commodities. And one thing led to another, and we certainly didn't call it QIS in those days. But essentially, that's how I got into this space. And I guess I've been involved in systematic strategies, whether they're implemented in index format or sequences of vanilla trades ever since.
Really interesting. I love the early days in trying to model out credit risk on the sovereign side. And so, as you were describing that, I was thinking about the Eurozone, the crack up in 2011 through 2012. And for the first time, the market had to confront credit risk in a substantial way for what were, at least initially, developed market sovereigns. This idea of default became a real thing. And then as Draghi really got his arms around it and just put his thumb on the scale in terms of the ECB's ability to effectively put an end to the crisis, at least the pricing part of it. Just curious, maybe reflecting on that post sovereign crisis era of maybe it's 2014, 15, 16, when rates are just impossibly low, with Europe being really the center of the negative rate phenomenon. What did that mean just in terms of thinking through the credit risk for weaker countries that are linked to a central company, like let's call it Germany, where the policy rate is zero and rates are clearing the market? at a negative level. How do you think about credit risk for, let's say, Greece in the 2015, 16, 17 era?
Clearly, it got a lot better, and there was a massive spread compression of the European sovereigns. And it's interesting, you say the post sovereign crisis era. There have been a number of different sovereign crises, and that was definitely the European sovereign crisis moment in the sun, so to speak. But I remember back in the late 90s, as many of the dealing desks in London were getting ready to trade government bond markets in a single euro context. And there was a lot of debate about how does one model that risk. And this comes back to the credit risk point. It seemed maybe a bit unorthodox at the time, but a lot of people thought that actually every single government out there, including Germany, could be seen as trading as a credit relative to the Euribor curve, to the Euro swap curve, so to speak. And that's not a stupid way to model things, actually. If you think about it, government bond curves have always been a bit of a pain to model. There's so many mechanical issues in government bond markets, the differences in coupons, differences in tax treatments, who's trading special, who isn't. There are a lot of reasons why government bond curves are kind of a mess to model. Swap curves, I think, have always been a lot more clean, a lot more well behaved in terms of fitting a curve to those points. So trading the government bond markets as a spread to the swap curve, I think, had a lot of logic, although many people, especially the old timers in the industry, didn't like it very much. So I think then, as today, you could think of all European countries and all, especially European countries, sharing a common currency as trading as a spread to the Euribor curve. And many people, I think, are nowadays definitely trading or thinking about sovereign spreads as asset swap margins to the Euribor curve, or even in sterling, people are trading gilts as asset swap margins to the sterling swap curve. I like that idea, I guess, from a technical perspective. I mean, perhaps you were thinking more in terms of a macro perspective, but if I could address that as well, definitely post Draghi's whatever it takes moment, we saw a huge reduction in volatility across the Euribor curve. You could even go so far as to say European interest rate markets became incredibly boring. Implied vols went really, really low. The curve barely moved, particularly at the front end. I think a lot of very experienced European interest rate derivative traders just got bored and left the market and started trading crypto or whatever gave them more of a kick. And I think that's really, really interesting because it coming up to when the ECB did its big turnaround in late 2021, when they admitted they couldn't keep rates low forever in the wake of increasing inflation, I think the market was generally unprepared for that. I think a whole generation of traders had just never experienced the European interest rate market being exciting. And many of the dealers on the street, as far as we could tell, like many of the hedge funds, were positioned short. They were positioned short vol, they were long these front end carry trades, and they got seriously, seriously hurt when that market finally came alive again in terms of inflation risk.
We've got Japan still, maybe the last one standing, just in terms of its monetary policy rate and the negative interest rate experiment. As you sort of think through that period for the Eurozone, the deposit rate, what was it, -50 for an extended period of time, as you're suggesting. Maybe that's in the dustbin of history now. I don't think most look too kindly on the efficacy of the negative rate era, but finance is a never say never business. So who knows? Maybe we'll be back to it at some point. I'm curious if you were to reflect on that era and just some of the maybe quirky math outcomes that come from curves that are based off such a deeply negative policy rate and even long dated rates. I know the German Bund traded at -70. I think the 10-year future traded -70 in terms of an implied yield at some point. What are some of the just really interesting mathematical outcomes that are derived when that policy rate is so low, whether it's through forwards or implied vol outcomes? Can you just recall some of the things you looked at and said, boy, this price is a real head scratcher, and it's probably linked somewhat to that negative policy rate?
The most fundamental thing to say, which actually didn't really start with Europe, but started with Japan in the late 90s when they first started to go into their zero interest rate policy, is for years and years up until that point, a lot of people poo-pooed the Vasicek interest rate model or any normal rate model that could conceivably allow an interest rate to go negative. People said, oh, that'll never happen. We should just only use log normal models or Cox-Singer Saul-Ross kind of square root process models, because obviously the interest rate can never go below zero. There are a lot of problems with that, is that even if the rate didn't go below zero, if it were trading very, very close to zero, you start to get some really weird math issues in terms of how do you price vol in a way that doesn't involve log normal vols of several thousand%. I mean, if you think about it, if let's say the interest rate is trading at 1 basis point and you think the fair value is something like 30 basis points, what does that mean in terms of log normal vols? You start to get into just craziness in terms of how do you calibrate models. And so I think the done thing for Japan, quietly or not, was to migrate to normal rate models because they were so much easier to specify. And eventually, I think that went global, but it was particularly relevant in Europe. I mean, another technique is to set the base rate or the extreme low rate at some negative number like minus 400 basis points, and then use a log normal model on top of that, just shifting the whole curve. That was an interesting change to witness, is how people migrated their techniques towards normal and then away from normal again. And I think now, I think a lot of people, obviously they model different curves in different ways, but I think a lot of people are coming to the view that maybe the curve is probably somewhere in between normal and log normal in terms of its dynamics.
One of the things you just mentioned is as you get down to the zero bound, vol just kind of gets squished. You really lose one side of the distribution, but maybe not entirely. I mean, I remember for several years just looking on the Bloomberg screen and looking at negative strikes on listeds for Euribor options, and just was just fun and fascinating to look at. And I
Yeah,
always thought, okay, so how does the market price the most deeply negative strike? What vol is assigned to that? It's almost as if you think about really far out of the money VIX options and the puts. What does the market pay for a 10 strike put on the VIX, with the notion that, yeah, you might get there, but boy, you can't really get too much further? What was the vol associated with deeply negative, the most negative strike, if you can just recall roughly, not the number, but how did the market treat those far out of the money negative strikes?
believe it or not, it wasn't as crazy a scenario to think about. I mean, one of the more technical factors involved in some of those deep out strikes was that some structured notes had zero floors on interest rates. If they were floating rate notes, the coupon could never go below zero, but many of them didn't. Many of these notes were issued in an earlier time when no one could possibly conceive of a situation in which LIBOR could go negative. So a lot of investors and market makers were sitting on exposure where potentially the floating rate note could fix below zero. And so people had to protect themselves. Many of them needed to buy these low strikes precisely for that reason. It wasn't that they were taking some crazy view on massive QE or whatever. It was they had a real exposure because of documentation in ages past that was catching up with the current market.
It's interesting how sometimes these assumptions in contractual form get baked in that are just overlooked. That similar sort of dynamic has shown up in some CLOs. The market just forgot these things can happen. As I said, prices are never say never. So, Tony, you had referenced credit options and the credit vol risk premium. And I figured that might be an interesting place to start. One of the most basic and tried and true sources of alternative risk premium is this thing called the VRP. And at its most basic observation, it's just that the delivered vol in the S&P is probably a 20% shortfall versus, let's say, the VIX. And there's a million ways to measure this, but on average, the VIX is clearing the market higher than what the actual experienced volatility in the S&P is. And there's an opportunity to step in. And of course, you're going to take your nicks and sometimes worse along the way, but there is some premium to be accrued over time. And so I think that could be a backbone for some of the conversation that we have on QIS. I was hoping you could reflect on the similar concept in credit. You seem to have alluded to it before. And so I was just hoping you could expound on that a little bit more, the premium and in terms of the credit vol markets?
Well, first of all, I'd just like to caveat this by saying the credit vol markets are very small relative to the equity markets, equity volatility or interest rate volatility or even FX volatility. So I don't think we can make deep, conclusive statements about credit vol behaving like X or Y. But one thing I think it's also worth pointing out at a more basic level is that many people would view just ordinary credit as itself a derivative product. I mean, if we go back to the Merton model of I think 74, where he talks about corporate bonds, I think it was the first major academic treatment of credit as an option. He basically said that you could think about a corporate bond as a vanilla government bond plus a short put option on the value of the firm, i.e., a default would occur if the assets of the firm fell below the liabilities of the firm at the date of expiration. That's, I think, an interesting observation. It may not be true precisely at a technical level, but we can all observe that if you look at the VIX over time, it has a very uncanny resemblance to, let's say, high yield spreads over time. So it seems like credit, even just vanilla credit, without talking about volatility, behaves a lot like equity volatility does. And the Merton framework provides a way of thinking about that I think matches that general phenomenon. And it also, to your point about VIX trading above realized vol, you could make a very similar statement about credit and say that credit spreads are generally priced way above actual default losses. In other words, if you thought credit spreads should reflect expectations of default loss and nothing else, they trade much, much wider than that. And so the question is, well, why is that? Is it because they're mispriced? Probably not. You could ask the same question about why VIX trades or why implied volatility. If we just are more precise about it, if we say the at-the-money vol of S&P 500 trades above delivered vol in the S&P 500, people could also tell a risk premium story. They could say there's a beta, that the VIX is highly correlated to the S&P itself. So if the S&P has a risk premium, the VIX should too, and that should be reflected in the way that it is. You could tell the very same story about credit. In fact, a lot of really interesting research on credit, the behavior of credit spreads in particular, shows that indeed the spreads are much wider than default losses would suggest they ought to be. But beyond that, it shows, I think, a very clear evidence of beta, that just like equities have a beta because they are linked to the market as a whole, so does credit. And there's a whole theory, which everybody who goes to business school is familiar with, about why any equity with beta should earn a risk premium, an expected return above the riskless rate. And yet somehow we never think to apply that to credit. And you could argue that equities are a special case of credit. They might be deeply subordinated credit instruments. So if you're worried about default in credit, you should be even more worried about default in equities, but nobody ever is. Anyway, if we go back to that point, I think we could argue that the VIX trades above realized vol, just like credit spreads trade just above realized default rates for a lot of reasons, but probably a big one is that both of these instruments have a lot of beta, and that beta deserves a risk premium, and it seems to be there in both places.
I think it was MIT professor Andrew Lowe had done some work. This is maybe 15, 20 years ago, but he had created this hypothetical hedge fund that on paper just looked gorgeous, up and to the right reasonably consistently.
Oh, yeah.
And,
Capital Decimation Partners, was that what it was called? I think
yeah, and
Capital.
it's like the turkey that meets its demise Thanksgiving Day. Every day up until then is great, and then it's just gone. And I think the strategy inside of it of Andrew Lowe's fictitious hedge fund was to sell like the 100 strike put on the S&P in, just giant size.
Yeah, that's right. I remember that.
So some part of this as well would seem to be the negative skewness of the returns in both VIX-like instruments, perhaps in equities as well, and certainly in credit as well.
And I think in that paper, if I remember it correctly, he brings up a related point to this, which is that when you have strategies that have highly nonlinear exposure, measuring Sharpe ratios is really quite misleading, or even measuring alpha. And alpha, in the sense of Michael Jensen's 1968 paper, where you do a regression of a fund return on a benchmark like the S&P 500. The intercept term is the alpha, and if that's positive, the traditional view is that that means the manager has some kind of special talent that is not in beta to the market. But in Andrew Lowe's paper, he talks a lot about how if you're doing a nonlinear strategy and you're trying to use a linear instrument to measure the risk, it's easy to show alpha, even if that manager has no talent whatsoever, because it's apples to oranges type of measurement approach. The measurement tool, in this case, linear regression, is just not up to the task of separating talent from just market exposure in the case of selling options, for example.
Well, let's talk about the QIS business and frame out Nomura's very specific forays into the business, how you've thought about building it out. Why don't we start a little bit from a 30,000 feet standpoint, and just for our listeners who may be less familiar with this kind of arcane product, but a growthy product on the street, give us just an overview of how you think about the product set, and then we kind of drill down into what some of the subcategories look like.
Yeah, sure. I mean, there's a lot of different ways to talk about what QIS is, but I think at its most basic level, you could think about it as a matrix. And I don't like the matrix example, but it's probably a pretty good one, where let's say the horizontal axis of the matrix talks about different asset classes like equities and fixed income and credit and commodities. And let's say the vertical axis of the matrix talks about different types of investment styles, where the styles could be as simple as long only, or it could be carry type trades, or it could be value trades, or trend following, i.e. time series momentum, or cross-sectional momentum. Or if you want to think about it as a separate category, and some people do, long volatility or short volatility trades. So within that two-dimensional space, you could think about each of those different boxes representing a different type of investment. So carry trades and currencies, or long volatility trades and interest rates, or value trades and equities. All of those could be thought of as different types of strategies. And you might ask the question, well, that's fine, but can't people do this themselves? And many people can. But I think one of the most economically relevant aspects of the QIS industry is that many investors would like to do a lot more in terms of strategies than their operational setup would allow them to. In other words, if I think about some of the trades we've been involved in the past, let's say you're a pension fund and you want to participate in the commodities market, but your back office has never done any commodities in the past, you might want to specify certain strategies that you want to do, but then deliver those in a total return swap context where the bank, i.e. Nomura or somebody else, puts those strategies in place, uses its own back office and operational resource to roll the futures contracts or deal with the underlying instruments, and then neatly package that portfolio into a single line item that the client can receive. So while we often talk about quantitative investment strategies as being full of high finance or theory or math, I would say it actually boils down to just operational convenience, that a lot of it just comes down to investors want to do things that their back office is incapable of dealing with. And so you have portfolio managers wanting to do things, but for operational risk reasons or whatever, they're not allowed to do them. And quantitative strategies can allow those portfolio managers to access things they wish to do, but that their operational constraints don't allow them to do.
I was reading something that was put out on the growth of the business, and Premia Lab, which you may know that firm that covers the street on QIS, had made a comment that more than 1,000 new strategy indices were created around the street in 2022. So there's seems like a lot active development in new strategies. Give us a little bit of an appreciation for the growth and the kind of timeline of maybe important developments. When did this business really start to take hold? It's got to get some critical mass for it to really get its legs underneath it. Give us just a brief timeline from your perspective of some of the important milestones and developments to how we've gotten to where we are now.
I mean, it's a really good question. Where do you measure the starting point from? I mean, you could go all the way back to the early 70s when a lot of the CAPM work was being done in California, and Bill Sharp and Stanford was doing a lot of this stuff. And the old Wells Fargo and Crocker banks in San Francisco were involved in creating the first index funds. And why do I mention that? Because quantitative investment strategies is really just another way of talking about systematic investing. And perhaps the first effort to be systematic and to move away from discretionary investing was probably the index fund. It was the first, I guess, quantitatively motivated approach to investing, and it was in the early 1970s. And that, I think, is an interesting starting point to think about an alternative way beyond traditional fund management of doing things. It took a long time to take off, but now it's become a huge sector. But I would say if we go to the modern era, I would point to, let's say, at least the early 2000s. I remember must be 2003 or 2004 when UBS and Deutsche Bank, who both had very strong interest rate trading desks at the time, were about the same time launching a product that Deutsche Bank called the forward rate bias product and UBS called the forward rate premium product. It provides an interesting case study of what originally motivated people to participate in QIS. And this was a very simple idea, really. It was essentially looking at the fourth euro-dollar contract, or in forward rate agreement terms, let's say a 3-month forward rate agreement starting 12 months out, and noticing that that forward rate was almost always higher than the associated interest rate that was delivered into. So you were talking about VIX being higher than realized vol, and I was talking about credit spreads being higher than realized default rates. Well, this was the short-term interest rate equivalent of that, where the forward rate contract was generally priced higher than the underlying that subsequently resulted. In this case, it would have been the 9 by 12 month forward rate that other thing delivered into. This, of course, is a classic example of the expectations hypothesis in fixed income, the idea that the forward rate is the best guess of what the realized spot rate is in the future. And this was evidence that this was clearly being violated. Now, I use the word violated as if this was a rule that should be true, but not everybody agrees it necessarily should be true. Again, one could argue that there are risk premia in interest rate curves as well, even so-called default-free curves. If there are risk premium, then there's absolutely no reason to expect the forward rate to be the best expectation of the spot rate in the future. But this was the focal point of product development back then. And you might ask, well, why were people interested in that? Well, it gets back to a very mechanical point, really, which is if you looked across the yield curve, there was a lot of evidence that the highest Sharpe ratios or the highest compensation for duration risk were actually occurring at the very front part of the curve, right around the 1-year point. And so you would have thought many investors would want to be there, but there were practical reasons why they couldn't be. In fact, many investors measured risk in notional terms as opposed to risk terms. And to take advantage of this front-end curve, you needed to use a lot of leverage. In other words, if you're owning a 1-year bond, for instance, you have a duration of 1, with the same cash, you could buy a 10-year bond and get a duration of 8, let's say. So in order to benefit from this phenomena of this high compensation at the front end of the yield curve, you needed to use a lot of leverage. And many clients simply could not do that because their risk systems were not able to distinguish between notional exposure and risk exposure. And this is to some extent analogous in the equity world to the so-called low beta premium. You could say there's a low duration premium in fixed income. Many investors, perhaps given that their risk systems are based on notional amounts of cash, prefer to put that cash into the highest volatility assets possible in order to maximize their returns. So how did QIS help? QIS helped because it could package all the leverage that was necessary into this note format and deliver a note or a swap to the end client that they could say, here is my exposure to this risk premium, and they don't have to do any of the leverage or any of the operational issues of rolling forward rate agreements or futures contracts themselves. It was all delivered very neatly according to a very precisely defined rule book that they could agree and sign off on before the trade. So this was, I think, a classic example of something that combined operational convenience with a well-known phenomena that people agreed was there, but they could not access easily using traditional fixed income instruments.
So interesting. And I wonder if there's a corollary there in the equity vol universe of risk premium. We, on the equity side, live in a world that the starting and ending point is almost always contango, sometimes deep contango. You could have a VIX of 11 or 12 and a 6 or 9 month VIX. I've seen it double that. You get a 26 or 9 month VIX, and people say, well, why don't you sell the longer one? It's much higher. There's a better opportunity to earn if you're selling it at a higher level. And a lot of the studies show that, and perhaps this is just turning it over so quickly, but even at a deeply contangoed shape vol curve, it's more economical. It's a higher Sharpe to be receiving the vol risk premium at the very front end. The story is still being written around zero DTE, but now you've got the ultra time decay in terms of trying to collect that VRP. It's interesting. I wanted to shift a little bit. I'll set the stage. We've lost two very prominent folks on the global stage this week. So, of course, Kissinger passed away at 100. And earlier in the week, Charlie Munger, Buffett's right-hand man, passed away at 99. Let us all live healthy lives that go that long. I didn't know much about Charlie Munger, but he's got some great quotes. And I just wanted to read a couple. One, he says, take a simple idea and take it seriously. He says, show me the incentive and I'll show you the outcome. I like that. And then there's another area, and I think Buffett's in the same camp here, and so is Druckenmiller, basically saying diversification is just, we spend so much time on it and it's just not worth it. Now, maybe each of those two folks has the luxury of not having to diversify. I happen to think diversification is pretty important. And so where I wanted to go with our conversation, Tony, in the realm of QIS, is these strategies. And as you sort of think about them from the portfolio construction basis, if I'm a client looking to engage in some of these strategies that generate, let's say, some version of alpha systematically, individually, I'm certainly interested in how they interact. I don't want to have everything effectively mirror the vol risk premium in equities. I was hoping you could just share some thoughts on that, as how you think about the interaction of different strategies. Are there one or two you might point to that are nice in combination, or especially effective from a vol dampening standpoint in combination?
A few minutes ago, you asked me about how do I describe QIS, and I mentioned the matrix approach, where the horizontal axis is asset classes and the vertical axis is investment styles. And I said I don't really like it that much, although it's a helpful explanatory framework. But the most important reason why I don't like that framework is it implicitly assumes that each of these boxes are quite different from each other. And to your point about portfolio diversification, it is often implied that QIS is great because you've got all these different things and all these different boxes that are different from each other. And I think the thrust of your question is that in many cases, that's simply not the case. And we could tell a number of different explanations for this, but perhaps one of the most classical examples is, let's look at the FX carry trade. Pretty simple idea. I go long currencies that have high interest rates. I go short currencies that have low interest rates. And you might think, well, that's crazy. Why does it work? And many economists have written very serious papers where they express a lot of Sturm und Drang that somehow the covered interest parity is being violated, as if it were, again, a rule that should hold. But other people have said, well, that's puzzling because why should the FX carry trade not work if it has, let's say, beta to some risk premium? And so a whole bunch of other papers were written about that, saying, well, we can't find any beta of any of these currency pairs. But if you don't look at the individual pairs, but instead you look at the strategy as a whole, so you look at whatever that strategy is, no matter what's in the long bucket or what's in the short bucket, you do find some actual beta to, we could call it VIX, we could call it beta, we could call it a lot of different things. But when there's trouble in the world and when there's trouble in the market, that FX carry trade tends to do very badly. We could say the FX carry trade is different, and it certainly is different in terms of the language you use to describe it, in terms of the instruments that you trade. But on the other hand, it's fundamentally similar in the sense that it tends to blow up at a similar time as other things in your portfolio might blow up. So another great example of this is coming back to European sovereign interest rate markets. Many people have said, oh, yes, I've got this long short strategy in interest rates, and it's market neutral and duration neutral. It's an arbitrage, blah, blah, blah. I'm being ironic for anybody who's in any doubt. I don't think arbitrage is ever very rarely appropriate. But the basic idea would be you'd go long bonds with high interest rates, high yields, and short the ones with low yields. But in practice, this meant you'd be long bonds like Italy and Spain, and you'd be short bonds like Germany and Switzerland. And guess what that looks like? Yes, it looks a lot like a credit trade. And when that trade blows up, it's usually when credit is blowing up, it's usually when equities are blowing up. So there are a lot of ways to construct strategy using a variety of instruments that certainly sound different and that would go in different boxes in this matrix diagram, but are fundamentally similar risks. That is something to be concerned about. And if I could tell a story about this, it goes back to the tools we were talking about before. What tools do you use to even measure diversification? Because it's a very often held view that the Markowitz theory is all you need, or the more modern versions of covariance theory, like principal components analysis and hierarchical risk clustering and all this kind of stuff. But all of those are in one form or another a variation on the covariance matrix idea. And the covariance matrix principle at its core relies on the assumption of bivariate normality. And I think markets generally just aren't bivariate normal. Let me get back to my story. It was just after the Lehman shock. I went to a commodities conference here in London, and everybody was licking their wounds because commodities had just crashed 50, 60%, just like the equity market had crashed. And it felt like being at a church meeting where the senior prophet had just passed away and no one knew why. And it was very much, we'll get through this together, guys. Keep the faith. We got to remember this is a 0% correlation asset. We have zero correlation with equities over time. This is just a rough patch. And I got up there and gave what might have been a very unkind speech. But I basically said, hey, there's nothing new here, guys. Commodities often crash at the same time equities crash. You just don't see it in the correlation data. And what I meant by that was if you look historically at the commodity benchmarks like the GSCI, in the old days it was called, going back to 1970, and compare that to the MSCI, of course you will see a correlation that's close to zero if you use an Excel sheet with the standard correlation function. But again, that's an assumption that these two indices are bivariate normal. I think a far more relevant question to ask is one that the correlation function can't answer or answers wrongly, which is what is the likelihood that commodities will blow up at the same time that equities blow up? And by blow up, let's define that as having a drawdown of greater than one standard deviation. And if you frame the question that way, there is abundant evidence that commodities are pro-cyclical in the sense that commodities are in a drawdown of this type 70% of the time that equities are. So if equities are in a big drawdown, it's highly likely commodities will also be in that drawdown. And what happened during the Lehman shock was a classic example of this pattern that had been evident for many, many years prior to that, but which you would never have seen by using a traditional correlation estimate. So I guess I'm jumping your topic a little bit, but I think it's highly, highly relevant here because looking at correlation is just not good enough to really understand how your portfolio fits together and the strategies within it fit together.
As I think about, let's just say, some commodity index and let's say the S&P, certainly not always, but you could argue that in a real shock, deflationary shocks tend to be dollar positive, at least for short periods of time. And so if each instrument is essentially negatively correlated to the dollar, they can become positively correlated to each other during that period. I wanted to ask you about this. As you were talking about commodities, I was thinking about just the interaction of investors in markets. And I was just recalling the spectacular rise and fall of Brian Hunter at Amaranth, trading natural gas futures in size. He had this giant calendar spread on, and he effectively moved the market his way probably for a year and a half, so much so that some of the best professionals out there just said, I'll hang it up and I'll wait for him to run out of the ability to keep the pricing there. And ultimately he did run out. And that story was a dramatic unwind. Had it happened at a different time, it might have had more systemic implications, but it was September '06, I want to say. And so the credit bubble was still in full sway. But it is the case that crowding is a real complicating factor in risk management. It can optically make things appear as they might not actually be. Vol can get really low in crowding. That certainly was the pre-GFC case. And so as you think about QIS, good strategies are going to attract attention. They're going to attract capital. How do you think about that part of it? That sometimes there's maybe alpha decay in strategies that are really working because people just crowd into them. Talk to us a little bit about how you would frame out that challenge in terms of designing trades and just being careful that something hasn't gotten too crowded.
I think of the great Groucho Marx, his line about never want to join a club that would take me as a member. And maybe that's a good way to think about crowding, although perhaps not very technical. I mean, a classic case of this was all those equity vol short strategies leading up to Volmageddon in, I guess, February 2018. That was clearly an evidence, perhaps, of overcrowding on that short vol trade. And there were a lot of signs. There were big subscriptions to ETFs. The retail sector was heavily involved. It's something I don't think you can ever be completely sure you're avoiding. What is a crowded trade depends a lot on the capacity to unwind that trade. And the capacity to unwind is often very difficult to know ahead of time. Even in markets that look super liquid, like cash equities, dealers can walk away from providing liquidity. And many of these liquidity providers aren't really there in the tough times. So it is something to be concerned about. I think there are some basic ways we try to avoid crowding, which is to try to find ideas that no one is talking about. When a lot of people are talking about something, that's usually a bad sign. So when everybody in the world is talking about strategy X, that's really the time to get nervous, I think. But if you're talking about something that no one's ever heard of, I think you're on pretty safe ground. And obviously, it's not like no one's ever heard of much, but there are things that are relatively unpopular, and they have reasons to be unpopular or just reasons that they're not very well known. Those are the kind of places you should try to focus.
I'd like to spend the remainder of our conversation on your work on long dated straddle swaptions on the rate side. So the 20-year, 20-year. And I was just thinking in the equity land, we'd have to take the 20Y and just write 20H for 20 hours. That's about that's Vega in the equity derivatives market.
Yeah.
You and team have done a deep dive on this. We're all looking for diversifying assets. We're looking for assets that are durable to shocks. And so oftentimes that does involve the purchase of some optionality. Optionality isn't free. And one of the threads throughout our conversation is that we're not going to call it overpriced, but there is a vol risk premium. You guys have come across some interesting results here in terms of overlaying these long dated swaptions on long dated rates. I'd love for you just to give us the overview, and then we can kind of talk about some of the, I don't want to say unexpected results, but just in terms of return attribution, I think there were some interesting conclusions that you guys demonstrated.
Nomura, a lot of us were around in the Lehman days, and we've had a very strong market-making franchise on swaptions. So we're lucky enough to have really good data and a lot of institutional knowledge and very experienced and talented colleagues who we can talk with. So it was very important for us to try to understand the long-dated swaption market just for the swaption market-making business, if nothing else. But bringing us back to the QIS business, an increasing theme in QIS space has been people in one form or another taking exposure to this part of the surface. And in many ways, that's a good thing. It's a good thing that a lot of people are looking at this. It's a good thing that people are learning about it because it was a relatively undiscovered part of the universe. But at the same time, our colleagues and I, we got increasingly frustrated at some of the things that were being said about the surface that we thought didn't really hold water and led to misunderstandings. And I guess one thing to start off with is the interest rate volatility surface just looks different from the equity equivalents. And the most important way probably in which it differs, and you can see this on any Bloomberg screen, is that it slopes up in the early days and it slopes down, or it starts high and it just goes down. whereas most equity vol surfaces go up. They're generally monotonically increasing. So the short expiries, there'll be X, and then there'll be X plus Y and X plus Z as you go to longer and longer expiries, whereas in rates, they'll often slope downwards. And so the first question I think one needs to ask is, well, why is this? Why do vol surfaces and rates look different? And one of the most annoying things that I hear over and over again, and I think every single sell-side research piece I've ever seen talks about this, and I think it's completely wrong, is they blame the Formosa market for this. They say, oh yeah, there are these Taiwanese dudes, they're insurance companies, they buy these long-dated zero-coupon callable bonds, and that's the reason why the vol surface looks the way that it does. Okay, so tell I don't really think much of this view.
Can you just
Clearly,
step back and just a little bit of an overview of that product and the way in which it's suggested that it's impacting the clearing price, it's pushing down the clearing price of long dated vol? In what way is that happening?
sure. So the Formosa market basically refers to a long-standing pattern in the market where insurance companies that are based in Taiwan buy US dollar denominated long maturity bonds. And we're talking about bonds that could be 30 years, 40 years. Often they have zero coupons and often they're callable. And like many insurance companies, people might be interested in maximizing yield. And a way to maximize yield when the yield curve is upward sloping is to buy super long dated bonds with no coupons and to make them callable. That will give you the maximum bookable yield. And for many insurance companies, maximizing bookable yield is the objective because they might go into hold to maturity books, so they don't have to worry about mark-to-market accounting. They just need to book the maximum yield, and as long as it doesn't default, everything's okay. That's the motivation in many investment segments in fixed income, which are not really mark-to-market oriented, but are about holding things to maturity. This market really got off the ground around 2015, 2016. The maximum issuance probably occurred in 2020 when interest rates were super low. But interestingly enough, as rates have surged, the issuance in the Formosa market really, really dropped off. So if the Formosa market were so important in interest rates, one might have thought that the volatility surface and interest rates would change its shape, but it hasn't. It's still pretty much as it always was. If anything, it's more downward sloping than before. So just as an experiential observation, it's very difficult to believe that if the Formosa market were so important to cause this downward sloping vol surface, we probably should have noticed a bit of a change since the Formosa market has more or less dried up for the last 2 years, but we haven't. The vol surface looks pretty much the same as it always has, if not more downward sloping. And I think this gets to the reality of the situation, which is that vol surfaces in general will have that shape. And one of the reasons for that is that the nature of interest rates is quite different from equities. And this goes back to the 1970s, even. The basic tool of modeling equities is a constant drift Brownian motion, the bedrock of the Black-Scholes model. Whereas the most basic representation of interest rates is a mean reverting process. We could look at the Vasicek model from 1977 as perhaps the first example of that. And if you just take that 1977 model by itself, the presence of mean reversion will generally cause long expiration vols to slope downwards over time. That's just the way it works. And so the fact that interest rate vol markets look the way that they do doesn't reflect anything about arbitrage. It just reflects the nature of the dynamic process underlying interest rates. I feel like that's a giant preamble. So anyway, I'm not saying the Formosa market isn't important. It has a very strong technical influence on things like seasonality and dealer hedging. But as the core cause of the vol surface looking the way it does, I think it's a completely bonkers story with no basis in theory or fact. Now, we could go one step further and say, what is also special about the long expirations of swaptions? One of the things that's really, really interesting about them is that implied vol generally trades below realized vol. And we were talking earlier about how in equities and in credit, you generally have implied vol or the equivalent of implied vol in credit, which is, say, the credit spread, trading above realized vol. So what on earth is going on? Is this an arbitrage? Do we finally see evidence of an arbitrage in a major market because implied is trading below realized? And again, no, I don't think we have an arbitrage at all. I think what is interesting and different about the swaption market, as you touched on, Dean, a few minutes ago, is the expirations are very, very long. 10 years, 20 years, 30 years in euro. So you could trade, let's say, a 30-year, 20-year euro swaption without too much difficulty. But what does that mean technically? It means that in the swaption market, unlike any other market, you can make a much finer distinction between gamma and vega, which is to say that gamma is highest at short expiries and it declines with time, and vega is highest at long expiries and it increases with time. What long-dated swaptions really allow you to do is to separate vega exposure from gamma exposure in a way that's really hard to do in other asset classes. Gamma is positive convexity. I mean, the relationship between gamma and convexity is very, very tight, whereas vega is a different animal. You shouldn't ever get paid to be long convexity. And the evidence that you cited in equities is evidence that you're not. If you're long gamma, you have an asymmetric upside. The market goes up, you make money. The market goes down, you make money. But vega is a different animal because if vega goes down, you will lose money. And I think you deserve to get paid to some extent for owning vega if it declines in a way that hurts you and so forth. Vega is not asymmetric, whereas gamma is. And at these long expirations, in many cases, you have much, much lower positive gamma and much, much higher vega. And so the scales turn. And there is, I think, the evidence of the market suggests that you deserve to get paid a risk premium, which is that implied below realized, for taking vega risk because you don't have the same degree of gamma risk offsetting that, which you do in shorter expiries.
I was just going to compare it to some of my own experience in, I'll call it long dated equity vol. And for us, that's 5 years is plenty long. We touched on it a little bit earlier. You did mention long-term capital. Of course, that's in the equity derivatives market, really the preeminent vega blow up, short by some counts 50 to 80 million of vega, and it moved probably 15 vols against them. There's another blow up, less well covered, but in 2010, when Buffett was essentially going to unwind his just gigantic position in short puts. So he was a giant vol seller, more just to collect the premium. There wasn't really delta hedging or anything like that. You had 10-year variance swaps in the S&P trade at 40. And so when I think about the clearing price of long dated equity vol, I think that there's an asymmetry of the distribution of implied vol. In other words, there's much more of a tail to the upside. It's not like long dated equity vol can collapse overnight, but you just have had these short squeezes that have been very unmanageable for people. So once you're short it, you're really never going to get it back. You're in it for life. Maybe that's a difference. The sort of the distribution of implied vol and long dated equity, let's use the S&P, has proven nastier for the short than the equivalent on the rate side.
That seems like a reasonable view. Also, I just don't think there are many natural players in long dated equity vol. I mean, you mentioned Warren Buffett, but I can't really think of that many other people who are even present in those long dated markets. And you mentioned LTCM, and even those guys were considered relatively rarities in just how long they traded, I think, currently. I mean, you would know better than I would, Dean, but as far as I can tell, the equity market doesn't really trade much past 1 year or 2 year expiries these days.
Well, just going back to the straddle swaptions and your results, you show some really interesting and favorable results to owning this position, this long dated swaption and long dated rates over time and through a couple of different vol regimes, through rate regimes. Walk us through the results and then detail some of the performance attribution. The P&L do Vega, the P&L do what you call the skew slide. Be good to learn a little bit more about the drivers.
One of the prevailing ideas in a lot of discussions of long-dated swaptions is that the volatility surface, since it's downward sloping, is giving you carry or some kind of magical arbitrage that when you, let's say, long in the 10-year, 20-year, since the vol surface is downward sloping at that point, the 10-year, 20-year vol will become higher as it becomes the 9-year, 20-year vol. And hence you should make capital gains. That's one idea. I think it's far less important than most people think. And if we look at the history, if we look through the global financial crisis or the euro crisis or the COVID crisis, we see a lot of interesting patterns, which is that owning swaption straddles is generally very helpful. It tends to rally when equity blows up. It tends to rally when credit blows up. And I think there's a couple of reasons for that. Number one is these volatility markets are linked. If equity vol shoots up in a serious way, rate vol is also likely to do that, and credit spreads are also likely to widen. But there's another reason for that too, which is that when you own a swaption straddle, not only are you long vega, but you've actually got quite a lot of gamma too. And when there's a crisis in equities or in credit or currencies for that matter, the interest rate market is not in an island somewhere. Generally speaking, there's a flight to quality. Interest rates move in one way or another, and that creates realized volatility, which is good for positive convexity exposure, which swaption straddles, if you're long, have a lot of. So we see this general pattern that swaption straddles are a good thing in a crisis, and they've historically done well when equities and credit have done badly. But what they've also helped with is underperformance in the bond market. So this brings us to the classic story of 60-40 or risk parity. And many people were very negatively surprised with how badly 60-40 or risk parity did in 2022 because they never assumed bonds and equities would both go down at the same time, but they did. And this may be related to the fact that people have come to view the risk parity theory favorably since it's based on the last 20 years of data when inflation has been low and bonds and equities generally moved in different ways in a crisis. But in 2022, they both fell the same. And by the way, if you go back further in history in the 1960s or 70s or even 80s, you'll see exactly the same pattern that bonds and equities tended to do badly at the same time. And this was when inflation was higher or more volatile than it was, let's say, from 2000 to 2019. It turns out that swaption straddles did extremely well in 2022. Equities were down, credit was down, nominal bonds were down, inflation-linked bonds were down, but swaption straddles moved higher in 2022. So not only did they help with equities underperforming, they also helped when bonds underperformed. And that, I think, is a fascinating result and something that might be helpful for a lot of people who have come to appreciate the limitations of the risk parity framework or the 60-40 framework in situations like 2022. You also asked about what are those drivers of performance. I mentioned that many people think that the main driver is this roll up along the volatility surface. I don't think the data supports that. What is going on? I think the most important driver by far is what we might call the convexity return, actually, i.e. the difference between implied vol and realized vol. This difference between implied vol and realized vol doesn't have an immediate impact, but it accumulates over time. So in interest rate markets, when people talk about 10-year, 10-year, or 20-year, 20-year, they talk about this segment of the curve as the vega part of the surface. And the reason for that is vega is the primary driver of return. In the very short term, if you look at changes in at-the-money forward vol, it lines up almost perfectly with mark-to-market changes of swaption straddles. So there's a very good reason for calling them vega exposure. But that changes radically if you think about long term. And one of the reasons we wrote this paper is it seemed to us that pretty much every treatment of derivatives, especially in interest rates, was from a trader's perspective. It was about pricing and hedging in the here and now, where overnight was long term. But very little was written from the perspective of an investor. How do these products behave over a year, over a decade? And that was something we wanted to investigate. And this brings us to the point that in the short term, yes, vega is by far and away the most important driver of return in the lower right in these 20-year, 20-year points or 10-year, 10-year. But if you hold them over time, what gradually happens is vega becomes less and less important. Volatility, as you know, Dean, is highly mean reverting. It goes up, it goes down, but it really doesn't move that far from where it starts on average. Whereas convexity is accumulating. And this difference between implied and realized vol seems to persist. And that is the number one driver of returns in our view. And followed up, the second most important driver would be the skew slide that you mentioned. When you buy a straddle, you're probably going to trade the strike that's equal to the at the money forward. But soon after that, maybe within 30 minutes or 30 days, that strike that you've traded at will move away from at the money forward. And hence you will be exposed to an out of the money strike, which might be higher or it might be lower. But often in crisis, what happens is that even if at the money forward vol goes down, the skew will get steeper so that you actually make money because your strike vol is moving to a richer part of the skew. And this is a rather difficult thing to explain to people the first time, but if you go through a few examples, it usually becomes clear and you look at the data. The sliding along the skew is usually a helpful thing, particularly in crisis. And that's what we would say is the second most important driver of returns.
It's really interesting work. And if we kind of step back and you reference the 60-40, bonds were for so many years, especially post the GFC, vastly negatively correlated to the S&P and delivering positive returns all the while. It's nirvana. Some really started to think about it as a positive carry hedge. They're pretty hard to come by. We probably had the illusion of less risk on our sheets than we actually had, and certainly 2022 proved that out. And optionality in the Nassim Taleb rendering is kind of one of the few anti-fragile assets out there, but it's anti-fragile only at the right price. And I think what your work is showing is that the price here is an interesting entry point. So it's really interesting work. Tony, it's been a great conversation. I wanted you to just reflect briefly on one more of my questions, which is just work in progress. Are there areas of investigation that you and folks on your team are focused on? Are there client deliverables that have gotten meaningful in this interesting time in markets that we find ourselves in? Where's the time being spent right now?
One of the fun things about our job is we look at a lot of different things. But one thing in particular that's taken up some time recently is a client that's involved in the mortgage-backed market. And before people start falling asleep, let's remember the mortgage-backed market in the US is about $7 trillion. So it's about as big as the entire European government bond market. And in days when the US Treasury wasn't borrowing so much, it was actually bigger than the US Treasury market in some years. And one of the most fascinating things about the mortgage market is its callability. So it's like a vanilla bond that you're long, but then you're short a receiver swaption, or equivalently, you could think about it as being short a call option on the underlying bond at a, let's say, 105 strike. It is often assumed that because you're selling optionality, you should be getting paid extra. And that's a large part of the pitch that people selling mortgage bonds give to investors. And one of our more astute clients has raised a rather subversive question, which is a very good question, which is, okay, what vol am I actually selling here? And number two, am I getting paid enough for it? Those are both really, really interesting questions, because when you're short the optionality in a mortgage market, it's like being short a Bermudan, because the homeowner can prepay at any time they like. So it's not a simple European option that you're short. So that makes it complicated. The whole tranche is amortizing slowly over time, which also makes it quite messy. But there are ways to try to guess which part of the volatility surface you're exposed to. And there are ways of measuring how much each parts of those volatility surface are paying you. And I would say that this is an area that really hasn't gotten enough attention. This client of ours was saying that there's a perception, I think, in the mortgage industry that all vol selling is good, but there hasn't been, let's say, a rigor at addressing the question of, well, exactly which vol am I short? And then the question is, how much am I getting paid for it? So without going into too much detail, those are two questions we're actively engaged in. I think we've got some really exciting results, which are very subversive, but why don't I just leave it at that?
Excellent. Well, Tony, this has been a great discussion. I've certainly learned a lot. I think our listeners are going to learn a bunch as well. So I really appreciate you taking the time. Thanks for being a guest on the Alpha Exchange.
It's been a pleasure, Dean. Thank you.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback. As we aim to utilize these conversations to contribute to the investment community's understanding of risk, your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.